Over the mortgage insurance premiums deduction worksheet for line 20 of IRS Form 172. So IRS Form 172 is a new form. The first year is the 2024 tax year, and I've received a lot of questions about certain items of deduction that you would calculate for this form. So part of this includes when we're talking about net operating losses, which are calculated on Form 172, there are certain losses that can be carried forward. So, for example, the mortgage insurance premiums deduction, which is no longer allowable as a current year itemized deduction on Schedule A, is still allowed to be calculated on IRS Form 172 as a carry forward. So the way you would determine whether or not this deduction is subject to a limitation is by completing the mortgage insurance premiums deduction worksheet. So if you're not familiar with mortgage insurance, if you remember what the term PMI is, that's basically private mortgage insurance. That's what you pay in addition for certain loans, particularly if you don't have at least the 20% down payment. You might be required to carry mortgage insurance, which is basically money that you pay the mortgage company to ensure that you keep paying the mortgage. So there's no benefit to you at all for mortgage insurance. And I believe after 2022, the IRS stopped allowing that as a deductible expense. I think that was part of one of the tax code changes in recent years. So you can still carry forward insurance premiums from prior years. You do need to run through this test to see if there's a limitation. So really quick, we're going to go through this as an example in a situation where the deduction is not limited and how you would go about it. And then we'll talk about a scenario in which there may be a limitation, and then you would walk through that calculation to determine how much the deduction should be and where you report it on IRS Form 172. So this is a fairly straightforward worksheet. We'll start with at the top with line 1. Let's just say that we're talking about a tax year 2022. We paid $10,000 in PMI, and this was for a contract issued after 2006. So we're trying to figure out whether or not we can carry forward the entire $10,000 or whether or not there's a limitation on it. So we'll go to line 2, the amount from IRS Form 172, Part 2, line 13. So really quickly, that would be what's known as modified AGI. And when we go through the calculation to figure out what modified AGI really means, it is your adjusted gross income before the current year net operating loss carryback. So before we do the Form 172, any carryback, so the regular AGI, and then we're going to add back certain items that were taken out of AGI. So the first item is the net capital loss deduction. Section 1202 exclusion, which you would enter as a positive number. The qualified business income deduction, or QBI, that would be calculated on IRS Form 8995 or 8995-A. And then line 6, the adjustments to gross income. Those actually include quite a few things, and I'll list them out. I'll list the form that you may find them on, but we'll put links in the show notes to resources that we've created for the forms and schedules mentioned here. So the allowance for passive activity losses, for rental real estate. That would be on Schedule E. Taxable Social Security, which you would receive well, you would calculate it on your tax return, but you would receive your Social Security actual statement on a 1099. IRA deductions, which you would enter into Schedule 1. The excludable savings bond interest, which is calculated generally on IRS Form 8815. The exclusion of adoption benefits under an employer plan, that would be on IRS Form 8839. Any student loan interest that was deducted, you would find that on IRS Form 1098E, that's reported to you, or the tuition and fees deduction, which would be reported to you on the tuition that you paid would be on IRS Form 1098-T. So all of those need to be added back into it, and then that helps you arrive at the modified AGI. So in this example, we're saying that our modified AGI is $100,000. This is a married couple filing jointly, so $100,000 is this number we put into line 3. And then we determine, is the amount on line 2 more than the amount on line 3? So in this case, the deduction is not limited because they're the same. You would take the line, you would enter the amount from line 19 onto line 20 of part 2, and then you would enter 0 on line 21. So let's go back to the form for a second. So let's say we had the $10,000. We would put $10,000 here, and then we would subtract these, and there's a 0 in line 21. And basically, that means that there's no limitation here. So that's how we would enter that in the form 172 itself. Now, let's say that our modified AGI is 150. Now we have to do this calculation down here under the yes answer. We're going to subtract the line 3 from line 2. So if it's not a multiple of $1,000, you would round it up to the next $1,000. In this case, it is $50,000. We don't have to do that silly math. And now we're going to divide this line 4 amount by $10,000. So that would be 5. And we enter the decimal as 1.0 or more. So we're going to enter 1.0. And then we multiply the line 1 by line 5, $10,000. And then we subtract line 6 from line 1, which means basically that's the amount that we're going to enter on the line 20. And then we would have to actually exclude that mortgage interest because that wouldn't be allowable. Now, what if it's somewhere in between? Let's just say that we're talking about $105,000. And so now this is a $5,000 difference. And we're going to divide line 4 by $10,000, which means we get a 0.5. We multiply the line 1 number by line 5, and we get $5,000, which means $5,000 of that is excluded, and we have a $5,000 recalculated deduction. So we can then go back to the form. We would enter the $5,000, and we're able to claim half of that as a deduction. So basically, the second half of this is really calculating the phase out. You can kind of do the math and figure out that by the time you get to $110,000 up here, then the phase out is pretty much complete. So you would be completely phased out by the time you get to here, simply because you reach that magical 1.0 mark. That means that everything here is going to result in a 0 in line 7. So the phase out is between $100,000 and $110,000 of modified adjusted gross income for married couples filing separately. That phase out appears to be somewhere between $50,000 and $55,000. Again, this isn't the end all be all. This is simply the worksheet for line 20 of your mortgage insurance premiums. You would still need to go through the rest of the form to figure out the entirety of your net operating loss carryover. So, like I said, we'll put links in the show notes to resources we've created specifically on the forms and schedules mentioned in this video. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, or if there's another topic that you'd like to see in an upcoming video, please hit me up in the comments section. Thank you very much and have a great day.